we're bookending two radically different comments. One from you to start the week, basically saying this market was like a Ponzi scheme. And we end the week, middle of the week so far, with Bob Prince of Bridgewater saying it's the end of the boom-bust cycle as we know it.
Yeah, I find that really interesting because, first off, Bridgewater, the people there are very smart.
Smart money.
You know, look, if you take the history of the United States since the late 70s, I would call monetary policy a policy of bubble to bubble. For instance, you know, to save the economy after the stock market crash, the Fed cut rates and overinflated commercial real estate, and then we had to bail out the banks with the Resolution Trust Corporation. So then once things calmed down again, investors no longer thought that commercial real estate was safe, and they inflated the internet bubble to the wealth effect to keep the economy going. And then, of course, it went bust, and so then people didn't feel safe in stocks, so they started buying homes. And we played that out, and it bust. And so my attitude is when you look at the amount of leverage in corporate America and where we are today, you definitely are inflating a bubble here in credit.
Well, let's talk about the quote that you sent out to clients. A long note, I've read it. Here's a quote from it. The timing is hard to predict, but it reminds me a lot of the lead up to 2001 and 2002. Then you pointed out the term Ponzi scheme, where the only reason investors keep adding to risk is the fear that prices will be higher tomorrow. With that in mind, you've made this call. Are you de-risking or are you staying long risk? What are you doing?
You know, I got to tell you something. We started de-risking back in 2018. And I can tell you that I was an investment genius in 2018. But when the Fed pivoted, you had to ask yourself a question. And I'm guided a lot by behavioral finance and the work of Danny Kahneman, who won the Nobel Prize. One of the biggest mistakes asset managers or asset allocators make is they try to do too many tactical trades. And so what Danny would say is, look 5 years into the future, what do you see coming? And don't change what you're doing to try to catch a tactical move. So, you know, and so in 2019, as an investment manager, I looked like an idiot because we've trailed a lot of other people who've basically just said, hey, you know, wave in corporate debt, wave in high yield, you know, let's go for it. And, you know, someday, you know, the music will stop. But
is the elasticity when the music stops something anyone can manage, including smaller investors listening on Bloomberg Radio, watching on Bloomberg TV? Is the elasticity or malleability of the system there so we can respond and react when we get that? Or is it a jump condition where it's going to be ugly?
Well, you know, one of my colleagues at Guggenheim likes to say that asset prices go up on an escalator and they come down.
Well, normal.
And
Absolutely.
They come down in an elevator, right? So the problem is, since nobody I know is smart enough to figure out when the music stops, you know, I think that's a really difficult thing for people to try to time. And, you know, here, as an example, if 2 days from now or early next week, there's an announcement from the Federal Reserve or in the Fed meeting on Wednesday that they're thinking about tapering the bill purchase program. Remember what happened when we talked about tapering QE in 2013? We didn't even need the act.
That was a taper tantrum, and this is going to be called the Maynard tantrum.
Carry on. Is this QE then? James Goldman, Morgan Stanley, sat in your seat, said exactly the same thing.
Yeah,
many people disagree with you, though.
Well, I mean, I got to tell you something. When I talk to people at the Fed and other believers that don't think this is QE, they say, oh, well, the Fed isn't buying longer-term duration assets to affect the shape of the term structure of interest rates. And my response to that is, look, I think the official name of QE is large-scale asset purchases, right? And this looks like large-scale.
Well, I spoke to Ken, and John, this is important. I spoke to Ken Rogoff 2 hours ago on a panel here at WEF, and he alluded definitely to what Mr. Maynard's saying, the idea that, look, it's QE, it's not QE, doesn't matter. The fact is they're affecting the process, which changes the behavior of the market.
This debate's going nowhere, Scott. What I want to try and understand is, what is the risk of getting it wrong?
Well,
what's the risk of saying it's QE if it's not QE, and what's the risk of saying it's not QE when it is QE? Is this just a debate just to have behind closed doors, or does it actually matter?
I think whatever label we put on it, the consequences are the same. And that is that when you put liquidity into the system and you create money, which is what the central bank is doing, it doesn't matter what you buy. You could buy baseball cards, right? But that liquidity leaks out into other asset categories. And so you get inflated prices in other areas. And, you know, as I've talked about in the recent piece, corporate bonds. You know, with central banks in Europe and Asia running negative interest rates and the Fed pumping out liquidity, you know, it just, the incremental stretch for yield just keeps compressing risk assets.
John, I invested in baseball cards years ago. I failed. I bought Oil Can Boyd where I should have bought Lenny Dykstra.
Should have waited for the Fed to buy T-bills.
I want to get to
it's the baseball purchase program.
To John's question about the news you've made here, Scott Meinert, about a Ponzi scheme. That assumes under Ponzi, under what we know of Bernie Madoff, there's someone ill out there. There's someone evil. There's someone bordering on civil or criminal violation. Who is that person within the Meinert Ponzi scheme?
Look, well, I mean, I'm not so sure that when Hyman Minsky framed the comment about a Ponzi market, that he was thinking that there was some nefarious activity going on. It's more of an investor behavior which is being encouraged, if you want to find out.
By who?
By the Fed. Because we're just, you know, every time, look, there was a debate back in December, you know, do we have a Powell put, right? We do.
It was delivered, silver platter.
Yeah. So we're operating back in that mode again.
Before you go, we need a conviction trade. Big calls, made a lot of headlines.
Right.
Where do you put your money? What's the #1 conviction trade right now for you, 2020?
Silver.
Silver?
Silver?
Yeah.
Why not gold?
Because when you look at the relative values of silver and gold, silver today is about, let's say, 65% below its prior peak. Gold is getting very close to its prior peak.
Can it go exponential like we've seen in some of the non-precious metals?
I think there's a high probability of that.